Hey everyone, we've been investing $10 a day for an entire 15 months and we've been doing pretty well, and we're going to show our holdings today, and this will be our 15-month update. We're actually well above the halfway mark. We've been doing pretty well. Toward the end of the video, we're basically going to show whether or not we're still beating the market, because the whole point of this challenge is to show that even with a little bit of money, you could still potentially beat the market. So let's get into it. Basically, we're sitting at $5,500 or almost $5,600. We've basically gone down about $300 from our highs. So our return was pretty dang good a couple months ago, but we've pulled back quite a bit. And I'll show you some of the reasons for that. But if we look down here, we're basically just going to go from our top holdings to our bottom. TLT's long-term treasuries, that's kind of a long-term play. I don't know if we're actually going to get any returns from it by the time I finish this challenge. The whole goal of this challenge really for 2025 is to get to 10K before the end of next year. So coming up, we're about to have New Year's and everything. That's kind of my goal, is to try as hard as I can to hit that 10K. Might be a little bit difficult if we do have some market slowdowns or anything like that, but it's definitely an achievable goal. But basically, we've got Ulta, Elevance. You can basically just look at all these holdings. They're almost all the same from our last update. We still have Atcore and Stellantis as those kind of weird plays. But if we go to our total percentage change, here's where you see the real picture. We've sold a lot of stocks already over the past several months, and you've seen that in the last update, but we made a decent amount of return on all of those sells. Now we're kind of just holding. And recently, we've had a pretty significant pullback in the healthcare sector. The overall market has pulled back a little bit, but the healthcare sector has hit us really hard. And I started buying a couple of healthcare stocks that basically seemed very undervalued right before all the drama started happening and healthcare stocks started getting hit. If you want like a super in-depth, well, not super in-depth, but if you'd like a somewhat in-depth explanation of what happened, I'll have a link to a video in the description where I basically go over what Donald Trump did, what happened at United Health and all of that, and why exactly healthcare stocks have fallen so much. Some of them have fallen almost 50% over the past 6 months. But anyways, we've got Elevance Health as one of them. We're down only 10%, which I started buying this at a pretty low amount. But if you look at the 3 months, we're down 30%, the actual stock. But in our portfolio, we're only down 9.5%. So we basically started buying just around these levels. And this is honestly really good. If we look at the 1 year, just from the all-time high, we're down quite a significant amount. I mean, that's probably around 40% or so. I'm really expecting a good pullback in healthcare stocks, especially if with Trump's administration things change and maybe it's not as bad as everybody's expecting it to be. And that's kind of what I'm expecting. So I definitely could see a nice jump in healthcare stocks. Our other one was CVS, and this one's fallen significantly. I've been buying CVS for quite long. So this one's been on a pretty significant downtrend for a while. And I've just been kind of averaging down on it. I think this company is pretty undervalued, or not company, this stock is pretty undervalued. Even at the levels that I was buying it at, and all of the healthcare drama kind of hit it even more. So I'm thinking of potentially building this up to maybe a $500 position. The real big risk, other than the regulatory changes, is really its debt. The Fed, which also in the video that's in the description, I talk about the Fed updates and everything, but because of the Fed, stocks like CVS that have an extreme amount of debt could get hit if the Federal Reserve were to keep high interest rates or potentially even hike interest rates. But I'm still expecting the Fed to honestly cut more than they have publicly said. So with that said, in my opinion, CVS is going to be a very interesting turnaround play. Um, as for a dollar amount that I would be selling this at, I mean, the average cost we've got is almost $60 here. But we're down from all-time highs of about $100 or so. We're looking at basically, let's see, we're looking at 2012 lows. So this company hasn't seen these prices for over 10 years. So basically, I'm just like, you know what? I'm gonna average down. Hopefully, get my average to, well, if I get $500 in here total for market value, that would probably bring our average under 50. And then I don't know what price I would want to sell at. I would maybe start liquidating the position at $70 or so. But if CVS starts paying off their debt, if interest rates go down, I think CVS could be favorable for the overall market. Institutional buyers have actually been loading up on CVS for I think over the past year, and even before that. So there are a lot of like really big investors that have been buying CVS at even higher prices than it is right now. So it'll be interesting to see with the next 13F filing, whether or not they're going to be picking up more at this price or if we'll see any surprise sell-offs. If we do see them in the 13Fs, that means they probably already sold off like right when Donald Trump news came out and everything like that. But anyways, just looking at the other holdings, I mean, not too crazy of returns here everywhere, but for our Chinese holdings, a lot of the Chinese stocks are still quite down. That's honestly my little bit of a hedge against the U.S. economy. If Chinese stocks rebound and the Chinese economy continues booming like it really has been, stocks like JD.com, which we already have like a really good return on it, 42%. I want like over 100% return on this. Stocks like JD.com could rise quite significantly, and as you can see, based on the all-time high, there's a lot of potential growth to be had. Other than JD, we've got Baidu, and Baidu is basically I didn't start buying this that long ago. I think I probably started buying around here, so about a month or two ago, and it is down significantly as well. Looking at the 5-year, I mean, obviously during 2021, this was like a crazy bubble. I do not expect these stocks to go up to that price anytime soon, if ever, even, who knows. But these Chinese stocks, I'm expecting at least a double up if we have favorable market conditions. So that's the other one. Alibaba is our other one, and these three Chinese stocks, well, other than JD, Baidu and Alibaba are huge. Baidu is basically the Google of China, and Alibaba is basically the Amazon of China. So these have some really, really strong growth potential. So for Alibaba's down quite significantly as well. It did have a rally up about a month ago to quite high, which I believe I sold about $100 worth of it, if we look down here, or $200 worth. So let's see what our realized profit there is. So $36 of realized profit. And that's just because I don't want to have too big of a percentage of the portfolio in Chinese stocks. But Alibaba, I would expect at least to double up as well. If we're looking at all-time highs, I mean, this hit over $300 a share. So in my opinion, with favorable market conditions, this is an easy double up, in addition to those other two. PayPal, so looking at everything else, everything here, I'm basically not touching. Intel is super risky, but it's crazy to me that I was able to buy in so cheap for Intel. So my average cost is $20 a share, and like we've trended down quite significantly. And I actually sold a little bit of it as well, with like almost no a realized loss, because my average starting this position was a lot higher. But Intel, this was going to be an interesting one. I mean, if everything goes as planned, maybe not even as well as planned by the company, I think this could be a triple up, and that would be definitely interesting to see. In my personal portfolio, non-public, I actually hold quite a significant amount of Intel. So it's definitely a risky play, but that's one that I'm basically holding at a low average cost and selling calls on it. If you don't understand what selling calls is, just let me know in the comments, and I'll give you an explanation, because I don't want to go into it in this video. But as you can see, over the past 5 years, trended down quite significantly. And if we're looking at its all time, I mean, we're sitting at also 2012 lows. So kind of like CVS. So it'll be interesting to see how that goes. Comcast, I'm trying to build up a larger position as this. The spreadsheet right here that you see on this this computer screen behind me, that spreadsheet is basically what I use to figure out every morning what stock I want to buy. It makes it really easy because it's honestly hard when stocks are going up and down every day. They're different prices. It's hard to be like, oh, this stock is the most bang for your buck today, or like it's hard to make those decisions. I know I'm only doing it with $10 a day, but that spreadsheet at least helps me to be like, okay, these three are my top potential returns right now. So I'm gonna buy $5 of this, $3 of that, and $2 of that. Makes it really easy for me. All that is to say, Comcast is showing up as one of my highest potential returns. It is pretty high in debt, so interest rates will definitely affect this company quite a lot. I haven't really seen if this company's stock price has been correlated with interest rates, at least like treasury yields or anything. But it'll be interesting to see. I don't think it's too correlated, because we see this run up right here, and I don't believe that. Well, actually, it might be just a little bit correlated. I think yields actually went down a little bit and then went back up. Maybe that's why it's trended down. Anyways, interesting if it is correlated. I haven't checked. But Comcast has just kind of been in this weird range here. I mean, it's basically been between like 45 and I don't know, 30 or something. Yeah. So it's been in this interesting range, and it's kind of in the middle of that range. And using my Benjamin Graham's formula, basically I look at Comcast and I'm like, okay, this seems really undervalued, and I think it's got a significant moat. They're kind of breaking out into new markets, such as Xfinity Mobile, things like that. So for me, this is kind of like, you know what, I'm definitely willing to grow this position and see where it goes. The other cool thing about Comcast is they actually pay a dividend too, so it's not like a complete growth player, like where they're just burning cash or something. They're able to afford the dividend. It's a nice 3% while holding as well. So, anyways, that's just another plus of having it. Going down to PayPal, which is just going to be the last one that I talk about. The other ones, it's whatever. Google's obviously a monster. PayPal, this is one that I've been thinking about liquidating, but it's kind of difficult to pull the trigger, because, when you end up selling, like, this brings me back to the vibes of when I bought Meta at under $90. I bought a significant position. It went up like 50% or so, kind of like how PayPal did. And I sold it, and I was like, oh, I need Meta to come back down to like $90 or $100, and I'll buy back in. Well, guess what? Meta just kept growing, and their revenues kept climbing. Obviously, that increases the valuation, and it never got down to even the price that I sold at. So I think Meta's like at over $600 a share now, and I'm just like kicking myself, thinking, why would I liquidate this position? Like, I'm trying to basically day trade a monster company that I felt was severely undervalued at the time. But anyways, I don't want to make the same mistake with PayPal. I think PayPal's valuation is fairly valued. I would say, we got a 21 price to earnings ratio. It's a fairly strong growing company. So, it's hard for me to really liquidate this position. But just seeing like such a run up, being up 54%, I'm just like, man, I don't know if I should start selling this one. Obviously, it might be comical to some of you guys because it's like, dude, it's $300. Who cares? But like, that's not the point. The point is this challenge. I'm trying to beat the market, get the alpha and everything. So, it's more of just like me trying to maximize whatever returns I'm getting in this portfolio for the fun of it. But anyways, looking at the 5-year, PayPal's been at over $300 a share. And it looks like we've got a pretty good trend reversal. It's been a fairly strong trend for the past 6 months. So I'm just like, you know what? I'm not gonna make the same mistake as I did with Meta. I'm just gonna hold on to this one and maybe every 30% or something liquidate like 25% of the position. I don't know. We'll see. But anyways, that's basically it. These Donald Trump thingies, whatever they're called, they're going to be paid out January 8th. So we're going to have an extra $30. Woohoo. That'll be cool. Yeah. So basically, just to go over the returns of the portfolio, we're sitting at about a 30% weighted annual return. Now, if we look at how we're doing against the market, in our previous videos, as you saw, we kind of fell down a little bit with the portfolio value over the past couple months. Past videos, we've had an alpha of about 10%, which means that we beat the market by about 10%. Let's see if we're beating it right now. So for the S&P 500, it looks like we're sitting at over a 3 alpha, which is good. We're still beating the market. That's the whole point of this challenge. I don't want to look like a dummy and then, underperform the market, because it's like, why don't you just throw it into an ETF instead of doing this whole, swing trading, day trading, single stock buying. Against the NASDAQ, we are sitting at a 0.5 alpha. So not as good. We're still beating the market, which is great. But the amount of time and research that I've put into stocks and everything, and only beating the market by 0.5%, in a real world scenario, you probably wouldn't do that. You would probably just end up going with a low cost ETF like the QQQ and just ride it out, because time is money. Every hour you spend is like, time is your most valuable asset. So if you're spending time researching companies and doing all this stuff and making the purchases manually, and only beating by 0.5%, a lot of times that just won't be worth it. So, but for the sake of the challenge, we're doing it, and we're still beating the market. We're beating the NASDAQ and the S&P 500. So anyways, that's basically our returns. I know that New Year's is coming up. I really hope that 2025 will be super awesome for the $10 a day challenge. Like I said, we're going to be beating the 10K before the end of the year. We're going to do it. I believe. Obviously, it's going to depend a lot on the economy and on the market, but I truly believe, and we got this, and we got TLT as that hedge to potentially keep us from dropping too much during a correction. Anyways, I appreciate you guys for watching. Thanks for stopping by. Make sure to like the video, subscribe for more updates, and you know what? I'll see you in the next one.